I know that some people are even feeling that they made a horrible, horrible mistake going from a fixed rate mortgage to a variable rate when they renewed in the past, say, 2 to 2.5 years, right? When COVID hit and the rates went down. But guess what? The banks are absolutely loving this.
Like, subscribe, and share to Voices of Linden TV.
Hello, lovely folks. Welcome to another Money Minute episode. I am Ingrid B. Clayton. Today, I'm going to share why switching your variable rate mortgage to a 5-year fixed one could hurt your finances in the long run. Now, I know that most people who have a variable rate mortgage are getting very, very antsy since the prime interest rate has increased from 2.45% to a whopping 5.45% in the past 6 months. That is a rapid 3% in only 6 months. And so many of us have never seen that in our lifetime. In fact, I have never seen such a rapid increase in my lifetime. And I know that some people are even feeling that they made a horrible, horrible mistake going from a fixed rate mortgage to a variable rate when they renewed in the past, say, 2 to 2.5 years, right? When COVID hit and the rates went down. But guess what? The banks are absolutely loving this. The banks are loving the uncertainty that many customers are experiencing now. Perhaps they're even getting ready to go in for the kill, telling customers that this is the perfect time to lock in their mortgages while dangling the 5-year fixed rate in front of them. And especially for the banks that keep variable mortgage payments fixed despite the increasing interest rate, those are the banks that are really going hard at it now. In fact, I myself received a warning letter from one of my banks, and I do know that other real estate investors or some other real estate investors receive same. Perhaps you have received such a letter, and my letter states that my mortgage is approaching the trigger interest rate. And if it does, there are 3 options for me to choose from. Now, you may be asking, what does trigger interest rate means? And what options did my bank give to me? Well, let's look at trigger rate first. Whenever you pay your mortgage, do keep in mind that part of the payment goes towards reducing your mortgage balance. This is how you build up equity in your home. And the rest of it goes towards paying down the interest that is due. However, if you have a variable rate mortgage and the interest rate increases, as it should increase, say 3%, not say by 3% over the past 6 months, if your mortgage payment does not change with each rate increase, more of your payment will go towards interest and less towards your mortgage balance. So if the interest rate increases to the point where your payments cover the interest amount only, then that interest rate is your trigger rate. So put simply, what is happening here with your trigger rate is that the interest put it this way, the payments that you make towards your mortgage is really just paying down the interest. Okay. So payment is equivalent to interest amount. That's your trigger rate. So essentially, when you pay your mortgage, it's just paying the interest. Nothing is left over to pay down your balance. So if that happens, you're not building any equity in your home. And usually banks do not allow that. Okay, so let's get back to the options that my bank gave me. So the first option is increase my mortgage payment. And my second option is make a lump sum payment. So it's like a prepayment towards my mortgage, which automatically would reduce my mortgage balance. Or I could switch to a fixed rate mortgage, like a 5-year fix, which is what the banks love, right? And you might be thinking that switching to a 5 rate mortgage may be the best decision right now, but doing that could leave you at a huge disadvantage in the long run, causing you to pay much more interest than if you stayed with, say, the variable rate for the next 5 years. And of course, the variable rate is not the only option. I'll talk a little bit more about other options that you could have, which actually includes fixed rates, right? But why is your 5-year fix could leave you, or could affect your bottom line in the long run? Let's face it, it's obvious that the Bank of Canada is aggressively raising interest rates to tame inflation. That's the only thing there. It's like they have tunnel vision. Let's tame inflation. And that's all we're going to do now, right? But raising rates to record high is in such a short span. But raising rates to record high in such a short span of time will hurt businesses, especially small businesses. Many small businesses are just rebounding from the effect of the COVID lockdowns. And we could see many of them doing massive cuts to reduce payroll expenses. So what do you think will happen when employees are laid off in droves? Unemployment levels will start to increase, which is a key determinant for slowing economy. And if the economy slows down too fast, that could lead to a recession. And traditionally, what is the quickest way to boost the economy or stop it from slowing down? What's the quickest way that you have seen government use, right, to get the country out of recession? They reduce interest rate. So we could see rates going back down very soon. And I really don't have a magic wand, right? And I honestly cannot predict the future. But what I do believe is that if interest rate trend continues, if interest rate continues to rise, many businesses will be negatively impacted unless, and I say, unless government has a bailout strategy in the works. And who knows, perhaps they will just start printing more money, quantitative easing to give businesses some money to weather the interest rate storm. And of course, you know what will happen. When they do that, they just put the country in deeper and deeper debt. And when interest rate is high, when the country is in so much debt, that's not good for the country either, because all they're doing, they're servicing debt and the debt becomes more, right? And the interest is just massive, right? Exorbitant interest that they have to pay. So that may not even be a good strategy. So if the government doesn't have a bailout strategy, it's just a matter of time before massive employee cuts will begin and an employment rate shoot up. This means the Bank of Canada will have to switch gears and start to reduce interest rate again. But imagine if you're locked in a 5-year fixed rate mortgage that is now close to 5.5%. Most banks are showing now not quite 5.34, 5.4, and it keeps changing sometimes, right? But I'll say about 5.5%. How will you feel knowing that you're locked in at a 5.5% mortgage for the next 4 to 3 years when you could be back to a rate of 2% or even less sooner than later, right? Not good. Definitely something that is worth mulling over. So here's the thing. If your mortgage is coming up for renewal soon, or if you currently have a variable rate mortgage and feel compelled to switch to a fixed rate one, just for peace of mind. I love that some people love to have peace of mind because they don't have to worry. They know that it will be a fixed payment for a period of time. That's fine. But it's better to take advantage of a short-term fixed mortgage, perhaps like a 1-year fixed rate. So you'll have a whole year to observe how the Bank of Canada strategy plays out. That will not only give you peace of mind, but it will give yourself some options to consider after a year. So, you watch the market, see what happens, and a year later you can make a decision. Okay? So until next time, do what good.